Dumela. I will be doing question A, which is about the inventory system, and it is worth 22 marks for 13 minutes. You are given information relating to Patel's Pies. Patel's Pies is a local retail business that buys frozen pies, cooks them, and sells them to the public. Following record sales in 2021 of more than 200,000 pies, they invested in more freezers and ovens. The latest financial year ends on the 30th of September 2022. They use periodic inventory system. Immediately when you read that they use periodic inventory system, you need to know that to calculate cost of sales, you will use that formula: opening balance plus purchases minus returns minus damaged stock or stolen stock plus carriage on purchases minus the value of your closing stock plus any custom duties, and then you minus the value of your closing stock, and then you will get cost of sales. That's how you will calculate cost of sales. Immediately when they tell you that they're using periodic inventory system, all you need to remember is that you need to use that formula to calculate cost of sales. Then they told you that they value their stock using first in, first out method. First in simply means the first ones to be purchased first will be the first ones to go. Now, when you look at the table that you're given, they told you that Patel's Pies is granted 7 days by suppliers to return stock that they are not satisfied with. So if I bought goods today, which is the 31st of July, I should return them before the 7th of August because I've got 7 days to return those goods to the supplier. Now, if I return goods on the 7th of August, it means I bought them on the 31st of July. If I return goods on the 31st of July, it means that I bought them, it's 31 minus 7. I bought them on the 24th of July. Okay, that's what it means. So you just go back 7 days. All right. And to figure out when you need to return the goods and when you buy them today, you just count forward by 7 days. That's all you have to do. Now we've got opening stock on the 1st of October, which is the beginning of the financial year. We had 24 pies. Each pie cost 9 Rand. Please note that that 9 Rand includes carriage on purchases. And the total cost will be 216,000, which is 24,000 multiplied by 9 Rand. And for purchases, we purchased December 2021, 41 pies. Each pie was 6 Rand, including carriage. Multiply 6 Rand with 41, you are going to get that 246,000. In March, we purchased 32 pies. Each pie cost 8 Rand, which includes carriage. And 8 Rand times 32,000 will give you that 256,000. In June 2022, we've got 38,000 pies at 7 Rand each, including carriage. To get the total cost, you will take that 7 Rand multiplied by 38,000. That will give you 266,000. Under the number of pies, when you add 41,000 with 32,000 plus 38,000, it'll give you 111,000. And the total cost, when you take that 246,000 plus 256,000 plus 266,000, it'll give you a total purchases value of 768,000. That's all you needed to do there. Let us continue and read more information. I'll come back to that. The following information was extracted from the stock records. We've got carriage on purchases amounted to 12 cents per pie. For every pie that we buy, we paid 12 cents for transport. A total cost of 2,000 pies were returned from the March 2022 purchase. Carriage was not refundable on this purchase. When you calculate the value of those 2,000 pies, you need to exclude the cost of carriage. That is because the cost of carriage, you've already paid for it. There's no way that you can get a refund for that. That is why you don't subtract it. It'll be factored into the cost price of the remaining pies that we are going to sell that are available for sale. In C, they said we have 1,000 pies were thrown away as they went stale. Now, that is a bit tricky because they didn't tell us when those pies were purchased that went stale. And if it's any of the pies that we have, then it's going to be a problem to calculate the cost price. If we've got mixed pies that were purchased at different prices and we can't trace which ones were stale so that we can determine the cost price, we will have to use the weighted average cost to determine the cost of those pies that were thrown away. In D, we've got 122,000 pies were sold at 20 Rand each. So to get your sales figure, you'll just take 122,000 times 20 Rand. That'll give you sales. Fortunately here, it looks like they gave you the total cost of sales for the year, which was 890,916. It was going to be complex to calculate cost of sales because of what we have in C, where we have 1,000 pies that were thrown away, and we don't know what the cost price of those pies were, which was going to make life difficult for us. That's why they gave us cost of sales. Let's go to questions. The first question, we need to refer to information relating to Patel's pie. Question 1A, inventory system, 22 marks, 13 minutes. We need to calculate the rand value of closing stock for the year ended 30 September 2022. You need to remember that we are using first in, first out method here. The units that we had, the opening balance, which is around 24,000, those units are gone. And then we purchased more units in December. And guys, be careful, because someone might say that, yeah, but June comes before December. They don't look at the years. That is December 2021. December 2021 comes before June 2021. 2022. December 2021 also comes before March 2022. I hope that makes sense. So December comes before March 2022, and December 2021 comes before June 2022. So those 41,000 units, they must be gone. For March, those 32 units, we are going to subtract 2,000 units that were returned. So 30 units are gone. We don't know, actually. I don't know. And then we've got, on the 30th, we've got 38 units. So those will be, so when we calculate the number of units that we have as part of your closing stock, you'll start from the last purchase. The last purchase will be June. If that's not enough, let's say we are left with 75 units. 38 of them will come from June, right? So if we are left with 75 units on hand, if 38 comes from June, how many will come from March? You will take that 32, you will take 72. When you take 72, did I say 75? Yes, 75 units. When you take 75 units and you minus 38 units, 38,000 units, you will get 37,000 units. 30 of those units will come from March purchase. Okay, remember 2,000 of those were returned, and the other 7 units will come from December purchases. That's how we will calculate the value of your closing stock. But we don't know how many units we've got on hand. We still need to calculate them. If you have watched my previous videos on inventory, you can check out 2022 inventory question, 2021 inventory question, 2020 inventory question. I think I also have 2019 inventory question. When you look at those, by now you should be able to calculate the value of the number of units that are remaining. And the formula is quite simple. You just take the opening number of units, which was 24 units. You add purchases minus returns, and that'll give you 109,000. Then you minus anything that was stolen or damaged, which is 1,000. Whatever you have left, we'll call it pies available for sale. Then you're going to take the available for sale pies and compare them to the pies that were sold. Pies sold, it was given to you, they were 122,000. So we sold 122,000, yet we had 132,000 pies available. If we sold 122 and we had 132 available, that tells you that we still have pies on hand that were not sold, which is the difference between those two. 132,000 minus 122,000, that will give you 10,000 pies that we still have on hand. To calculate the number, the value, the rand value of these 10,000 pies, we are going to say we've got 10,000 pies on hand. Look at the last purchase. How many pies did we buy in the last purchase in June? We bought 38. This 38 here represents the last purchase, and 10,000 pies will come from that last purchase. See, those will be the last purchased, as I said. Those are units of pies purchased last. They'll form part of your closing stock. Only 10,000 of that 38 will form part of closing stock. And the cost price of each pie then will be 7 Rand. When you take 7 Rand and you multiply it by 10,000, you will have 70,000, which is the value of your closing stock. And that's how you will calculate the value of your closing stock in Rand value. The Rand value of your closing stock, that is. Done. Easy, right? All right, let's move on. They want us to determine the actual markup on cost that was achieved. Now, when you calculate the markup percentage, this is the formula that you need to remember. It's always gross profit divided by cost of sales and times 100. We don't have gross profit here, but we've got the sales value. We also have cost of sales value. We'll basically take sales minus cost of sales. That gives you gross profit, and you divide this by cost of sales. Your cost of sales figure was 890,000 something. I don't remember it, but sales was 122,000 times 20, if I'm not mistaken. Yes, that's what we've got. Now, cost of sales will be 890,960 times this by 100. It'll give you a markup. Your markup will be 173,000,86%. 1.3 says that the owner has established that 1,000 pies were thrown away during the year as they went stale. The only way she can determine the rent value of the loss is by using the weighted average method. Using the weighted average method, calculate the rent value of the loss. Now, you need to know the formula for calculating the weighted average cost, which is normally the opening value plus purchases minus returns, and you add coverage on purchases, divided by the number of units. Number of opening units plus number of purchases minus number of returns. Obviously, we don't have coverage in the denominator. I don't even know why I have that there. It's not supposed to be part of the formula, actually. You'll have minus returns or minus damaged goods. But the problem with these goods that were stale, these pies that were stale, we don't have the value. We will have to calculate the weighted average cost without including the damaged or stale pies. And we're going to use the weighted average anyway to calculate the value of those damaged pies. All right, I've just corrected my weighted average formula. And that's what you will get when you substitute them. Please note that you will take the value of your opening stock, which was 216,000, plus your purchases, which was 768,000. However, when you minus the returns, you only minus the returns, but the value of your returns, you exclude the carriage because carriage is non-refundable. So when you calculate the value of your goods returned, do not include carriage on purchases. I don't need to add carriage on purchases because that 768,000 includes carriage. That 216,000 includes carriage. The only thing I'm going to do, I'm going to exclude carriage when I calculate the value of goods that were returned. That is because carriage is non-refundable. We only subtract what is going to be refundable. So that carriage, we have paid for it. It's a loss, so it'll be included in the cost price, which is your weighted average cost. Opening units were 24,000. We purchased 111,000 for the year and we returned 2,000. That'll give you 7 Rand 28. Now we've got the value of the loss. You'll just take the number of units lost, which is 1,000. You times it by 7,28. That'll give you 7,280. Done. Easy. Right? Now let's answer the following questions. The owner, Shreya, decided to reduce the closing stock levels. Determine the percentage by which she reduced the number of units on hand. Note that, guys, when you calculate any percentage, it's always new value minus old value divided by old value. I actually took this from one of my students. I think he's doing math later. And this is what he came up with. And I thought, wow, this is interesting because I normally use the base minus what we have now divided by the base. And that they used to struggle with because I did it, I think, in grade 8 math. And that's the only thing that I remember from grade 8. But this one here, it was quite good. Now you need to ask yourself how many units were remaining from last year. Note that last year's closing value was this year's opening stock. And this year's closing value will be next year's opening stock. So take this year's opening stock and treat it as though it's last year's value. Actually, it is last year's closing stock. Now we're going to compare last year's closing stock with this year's closing stock. The new closing stock is 10,000 and the old closing stock was 24,000, and then you divide by that 24,000, which is the old. You will notice that you get a negative percentage here. You times everything by 100. When you get a negative percentage, it means that there's a decrease. It's a decrease of the percentage. And your decrease of a percentage will be 58.33%. Done. Right? Give 2 reasons why she chose to reduce the stock levels. First thing that my kids told me, well, one child to be specific here, they said that the product is perishable. Pies are easily perishable in cocoa still, so we can't keep them for too long. And the other one is that probably we're not selling enough. The demand is too low, so that forces her to sell pies before they expire. And one said that, oh, this is what I came up with. When you keep too much stock, there's a higher risk of theft. And someone said to me, and he asked me, why are we going to have high risk? Who's going to steal pies? Your employees can steal from you. And considering, guys, we're buying like 241,000 pies, it's easy for them to steal. So that is the biggest problem of keeping too much stock. The other one is that when you buy too much stock, it means your money is in the warehouse. It's where, in this case, it will be in those fridges. And when it's in those fridges, you can't use that money. You've already paid, you lost money. It's not earning interest. It's sitting there in the fridges and you're not selling it. And that is why we say cash is tied up to closing stock, which makes it difficult for you to have cash or buy any other things that you need because your stock, your cash is already spent on the stock that is sitting by the fridges or by the warehouse. And when you keep too much stock, there is what we call high stock holding cost, like storage, electricity for freezers, extra security, it can be stolen. And we have load shedding in South Africa, which becomes the biggest problem, which could result in your stock being stale. Okay, that's it. That is it. All right, in the next video, we'll be doing this over here. Just take a look at this. Okay, and we've got that over there. Wait, before that, we have this. Just read through that, read through this. All right, just to read through this, okay, and this over here. Let me see if what else I can give you here. Let me just give you the income statement as well. So this will be our income statement, incomplete income statement. We need to complete this. All right, as well as this here and that over there. Please prepare this authorized share capital and retained income. All right. Just prepare it before you check out that next video. And obviously, when you prepare retained income and ordinary share capital, you might need to prepare this as well. Just anything on tax and dividends. All right. And then we will tackle those first before we continue. If you could possibly do up to insurance, which is the first adjustment, I'll greatly appreciate it before we start with the next video. Thank you for watching yet again. I really appreciate it. Let's show people how easy accounting is. Please don't forget to subscribe, share my links in all your social medias, encourage everyone to watch my videos. And when you finally excel, when you get that distinction in grade 12, please feel free to let us know under the comment section that these videos actually helped you. All right. Thank you again. Thank you, Pretoria. Thank you, Cape Town. Thank you, Joburg. Thank you, Soweto. Thank you, Durban. Yeah, I think those are my biggest fives. It's Pretoria, Cape Town, Joburg, Soweto, and Devon. I really appreciate it, guys. Don't forget to like, subscribe, share, and let everybody know that accounting is doable. Khotso.